Dylan says, I got out of Open Door at the peak and into Rocket Mortgage. Thanks to you, Kevin, and the Alpha Pro. Let's freaking go. The Federal Reserve has responded to the drama of what's happening with Trump's tariff policy and this disastrous Federal Reserve or jobs report. On top of that, courts might end up saving the day, but not for the Epstein files. The Epstein files might be the coupon code for the expiring courses today, but when it comes to the Epstein update, apparently Maxwell has now been moved from a federal prison in Tallahassee, Florida, to a minimum security prison camp in Texas. Yes, Maxwell has been moved to camp as Donald Trump makes sure everybody knows that he has the right to pardon Maxwell, but he hasn't been explicitly asked whether or not he should pardon or to pardon Maxwell. But that's less important today because we know they're not going to release the files. And that's why we have coupon code release the files expiring later today for the Alpha Report and the amazing programs on building your wealth. But what we need to talk about is the Federal Reserve's statements on what's going on with this jobs data, both from Waller and Bowman. I'm also going to give you insight into what Bostic just said. And we need to talk about what's going on in court because this is kind of crazy because so far, courts have kind of been giving a lot of latitude to Donald Trump on a lot of different policies. It's possible courts might finally be U-turning here and actually strike down one of the most critical components of Donald Trump's economic policy, his tariff policy. The courts are not happy with the Justice Department and quite frankly, the attorneys from the Trump administration's arguments on why they should be allowed to implement tariffs without Congress. And if courts decide the tariffs are illegal, maybe we could prop up the jobs market without rate cuts and get back to some real enthusiasm. After all, the Qs today triple either rejecting or losing. Actually, this is about, I would call it about 3 rejections on the 557.20 line here. This is a line we were talking about in the Alpha Report this morning as well. But forget about the lines for a moment. Let's think about what the Fed just said. So this morning, Bostic came out as a real hawk on inflation. Oh, we need higher rates. We need higher for longer. But this is totally the opposite of what Waller and Bowman are saying. And some of the arguments they're making, kind of scary. In fact, Waller is going as far as suggesting we probably need cuts of 150 basis points. That'd be quite remarkable to see those sort of cuts. And if Waller were in charge, who's one of the candidates for the Federal Reserve, we might actually get them. ISM payrolls, for example, from manufacturing totally missed hardcore this morning. We'll go through Waller in just a moment, but ISM this morning contracted for a 5th straight month. While overall things are still slowly growing, they are slowing in their rate of growth. The unemployment index came down lower as well, which just compounds with what we saw with the jobs report this morning. And we're seeing that U.S. manufacturing activity contracted at a faster rate with basically every category of manufacturing dropping. And even though demand indicators improved, like suggestions that, hey, there's still basically contractions in we've got it right here. Contracting at a slower rate. The new orders and backlog orders index contracted at slower rates. In other words, we're still in contraction for the positive. It's just like kind of teetering a little bit. You actually look deeper into this. None of the 6 largest manufacturing industries expanded in July. None of them. Tariffs are beginning to wear us out. Sales are softening more than usual in the summer. Some businesses, like the furniture business, say business is steady for now, but they stocked up on a lot of inventory before the tariffs. Don't look on X for what's going on in Vegas or take my word for what's going on at Disneyland or Six Flags. It's dead. But take a look at this. For every comment on hiring, this is from the ISM report this morning, not even the labor report, right? For every comment on hiring, there were 2 comments for reducing headcount. And layoffs were the primary measure, an indication that staff shrinking continues to be urgent. This is bad. Remember, the last thing that holds this economy upright, or that is holding this economy up right now, is the fact that we're not yet seeing layoffs. And so a pause to Trump's tariffs could not come soon enough, because really what tariffs are doing is they're delaying the Federal Reserve from cutting rates because they're making the Fed nervous about inflation, while at the same time we're damaging the labor market twofold. Once, because we're not lowering rates, and second, because of the reconstruction of supply chains in general. Like all of these ideas of investments from large companies like Apple or, big AI investments or whatever, they got to translate to jobs. But when? At the end of Trump's term? Probably not at the beginning of Trump's term. You gotta get through these recessionary fears first. These are problems. But let's understand for a moment Mr. Waller's statement, because this one's pretty dramatic. It calls for a substantial set of rate cuts as soon as possible, which, makes sense, because when you look at that jobs report this morning, look at this. All these purple arrows here, declining jobs, and when you include the revisions in them. So revisions plus the last jobs reports. Goods producing, negative 41,000. Construction, negative 14,000. Manufacturing, negative 23,000. Trade and transportation services, negative 29,000. Retail trade, negative 9,000. Slower consumers, IT, negative 8,000. Remember Meta, negative 1% on headcount. Microsoft, flat. And these are the richest companies in the world, flat with hiring. AI doesn't necessarily mean you need more jobs. You use AI. Get more done. Financials were the only section that saw real job growth over here at 7,000, which is nominal outside of education and healthcare. But a lot of this was because of the insurance business based on the BLS report. Business services down 41,000, temporary help down 14,000, education and health, mostly healthcare, 67,000. So outside of healthcare, we do not have jobs. There are no jobs. They're gone. Negative 13,000 in leisure. These are horrible, horrible numbers. We better hope and pray that these numbers flip-flop. And maybe courts overruling Trump's tariffs will be the way to do it. Waller says that tariffs are a one-off price increase, that we should be looking through these tariff price increases and cutting rates. The problem is, Mr. Bostic says, the textbook says that the reason we have one-off price increases is because you impose the tariffs and then you're done. But that's not what we have right now. Right now you have, we're going to impose tariffs. Okay, maybe we'll impose fewer tariffs. We're going to impose more tariffs. We're going to impose fewer tariffs. We're going to impose more tariffs. We have all this vacillating of tariffs. And Bostic makes the case on CNBC this morning that the Federal Reserve needs to be really freaking cautious about inflation, because you're screwing with people's psychology. That people are dealing with these tariffs for a lot longer, because Trump's not just one time and in. There's so much uncertainty that people are constantly worried about pricing increases that we could self-fulfill price increases, and that the Fed's basically going to end up in a 1970s situation again where they lose control of inflation. Now, if we go into a recession, I promise you there won't be any inflation. We will eviscerate inflation immediately, but we'll be in a nasty recession. That's how Mr. Powell is earning his reputation of too late, because the reality is you don't have to worry about inflation if we go into a recession. You'll have deflation. That's bad. It's nice when prices come down, but it's bad because it means a lot of people are going to lose their jobs, and you're probably at a 15% unemployment rate or more, which takes forever to get rid of because of, well, frankly, artificial intelligence. Don't look. You could look on eHack or just download the Meet Kevin app. Remember, download the Meet Kevin app and you can get this. It's totally free, by the way. You can customize your notifications for the videos as well. So if you don't want the pilot videos or, Maxwell videos or whatever, that's fine. You can click out of those. But download the Meet Kevin app, again, totally free, and you could see the chart where we threw it today. And I think it's really useful because when you look in that Meet Kevin app, you could see that 27-week unemployed chart that almost nobody is talking about. Here it is blown up a little bit larger, but this is the app. You can get it as well. But here it is blown up a little larger. This is the 27 weeks unemployed chart, and almost nobody's talking about this, and it's skyrocketing. It's not good. Every single recession that we've ever had has been led by the skyrocketing of the 27 weeks unemployed. It's because people are struggling, they're getting laid off and they're struggling to find work. In fact, Goldman Sachs had a piece on this morning. I've got it right here. Goldman Sachs says that we're in the late innings of a systemic re-leveraging. Basically, everybody's going out and taking on debt And that's why the market keeps pumping up, because everybody's taking on debt, everybody's getting fully exposed. And, that's a risky environment, because once everybody's fully leveraged again, where does new money come in to keep the sort of like bubble going, right? I mean, we just hit over $1 trillion of margin debt, I think for the first time ever in history. Yeah, look at this. Margin debt surges 9.5% in June to record high. First time ever we've been at $1 trillion in margin debt, FINRA margin statistics. And that's June data. We don't even have the July margin data yet. Imagine what the July margin data looks like. We're probably $1.2 trillion in margin debt. It's crazy. But if you look at Goldman Sachs here, Goldman Sachs says there's no clear catalyst for a big collapse right now. I don't think they would have written this if they saw the jobs numbers this morning, because this was written right before the jobs data, 6:32 UTC, August 1st, so basically late yesterday. But take a look at this. They warn, watch non-farm payroll and ISM. Both were really bad. But take a look at this. This is a really critical thing to pay attention to. Right-hand side chart, this one right here, okay? Continuing claims are still near highs. This suggests many who lost their jobs earlier aren't getting rehired. Even if layoffs slow, dude, I'm not worried about layoffs slowing. They're slow. I'm worried about layoffs going up, because remember the beverage curve that looks like that right now? Okay, the normal beverage curve looks like this, which is basically when you have low job openings, you have high unemployment. But it looks like a line right now because we have low unemployment and low vacancies. As soon as we get layoffs, it normalizes and the unemployment rate skyrockets. This being the unemployment rate going up. This being job openings low, right? This is a normal curve. The straight line down is not a normal curve. We've talked about this before, so I don't want to rehash this. But the backlog of still unemployed workers could keep continuing claims elevated. Yeah, it's a red flag. It's a problem. So now, understand when Waller calls for 150 basis points of cuts, he's doing so because he's recognizing these fundamental shifts that are happening in the economy. We talked in detail about the day trade, the medium trade, and the longer trade this morning in the course member live stream. You can get the daily updates on this and trade alerts or anything if you join over at meetkevin.com. Remember, you join once, you get lifetime access. So even if you come back 5 years from now, you're like, I wonder what the trade is today that Kevin thinks. It's my perspective. I can't guarantee you. But what I can guarantee you is you get access to all the courses. You get my perspective and trade alerts. You get every live stream, every alpha report, all one price. Use coupon code release the files over at meetkevin.com. We've got a coupon expiring tonight, which just means the price is going to go up. So if you want to secure the lowest price, do so now. That said, look at Waller's commentary here, and then we got to look at a rough day in court for tariffs. But Waller's commentary is very concerning. Waller, calling for 150 basis points of cuts, says that real gross domestic product growth was just 1.2% in the first half. Now, he says much lower than the median participants' estimates for longer run GDP growth. This is a little misleading. What he's doing is he's referring to this longer term column right here on the summary of economic projections, which is right here, this 1.8. But really the 2025 projection for GDP in June, during the June SEP, summary of economic projections, was 1.4, which, 1.2 is relatively close to, but whatever. He's trying to talk up the desire of having rate cuts right now. Taking together, the data imply the policy rate should be around 150 basis points lower, at around 3%, the neutral rate. In other words, we should be cutting to neutral right now. So if it was up to him, and Polymarket is actually betting that he has a shot, at 13% shot, of being announced as the next Fed chair by December. If you remove this no announcement by December odds, he probably has like a 40% chance, maybe 30% chance of being the next Fed chair. He's calling for 150 basis points of cuts, rapidly getting us to neutral. And the reason for it is because the labor market looks fine on the surface. But once we account for data revisions, the private sector payroll growth is near stall speed, and other data suggests downside risks to the labor market have increased. Inflation has been limited. We should not wait for the labor market to deteriorate. the wait and see approach on tariffs is not what we need right now. It's overly cautious and doesn't balance the risks, because it's possible that the labor market falters before we ever get clarity on inflation. And when labor markets turn, they turn fast. This is scary. Think about this. They're saying we may not get clarity on what happens with tariffs for a long time, but as soon as the labor market rolls, we could be screwed. And we might be delaying for uncertain data we might never end up getting. So we should just cut now and then see how the data evolves. This was posted this morning by Mr. Waller. Bowman also dissented and wanted a rate cut in July. And she says that economic growth is slowing with a less dynamic labor market, and we should be getting back to neutral, which is also 150 basis points lower. We should proactively hedge against the weakening of the economy and avoid risking more damage to the labor market. Underlying economic growth has slowed markedly. Private domestic final purchases have increased, but not as anywhere close to what we saw in 2024. It's like half the rate. We're seeing softening consumer spending and declining residential investment. Remember what we talked about this morning? This morning we talked about like who wins during this kind of stuff? Who wins is corporations. The rich and corporations win because they can lay people off, right? They can lay people off and they could benefit from cost reductions because of AI, and they could use the cover of recession to lay people off. And then companies with money get to deploy and they make even more money. It's one of the reasons why HouseHack is hoarding cash, so we could deploy in a more panicky time. You know, we got like $13 to $14 million of cash right now. And it's also one of the reasons I say, you know, if the Fed cuts frantically 150 basis points, which right now the market is pricing in now an 88.7% chance of a single cut in September, but we are pricing in now 2.3 cuts by the end of the year. It keeps going up. You know, if we get sudden rate cuts, we're going to stop our fundraise right away for HouseHack. Why are we going to pay, our rental yield, 5% or whatever? Why are we going to pay 5% out through conversion? Then people get all the upside in stock. Like, we could probably just raise money with our, especially, once we release our AI product, hopefully later this year, our SaaS biz. Like, people probably just want to buy the stock and not need a 5% yield. Or we might not even have to fundraise at all anymore, depending on how much cash flow we can generate from our SaaS biz, which isn't really reliant on recession or not. In fact, our product probably becomes better in a recession because people are going to be like, which is the best deal of all these deals to choose from? But you really have to ask yourself that, like, yes, AI is great, but we gave this analogy in the live stream earlier. We're like, look, if UBS gets hired to do 690 investment deals to do research, without AI, they've got 128,000 employees to do it. With AI, maybe they could get the same work done with 90,000 employees. So all of a sudden, 38,000 people lose their jobs. But does that mean UBS gets more contracts? Like, do they do that much more business? Not necessarily. In the long term, yes. In the long term, AI or technological innovations will generally lead to more opportunities in the long term, but that could be 10 years out. In the short term, aggregate economic work requirements don't change because of AI. You just have fewer people getting the same amount of work requirements done. And it could take years for us to actually see AI create more jobs. I gave this example with Lauren. If you give Lauren 1,000 property management emails, pre-AI, you take her and 2 assistants and you get to work, you grind. Now you have AI, Lauren can probably do it all herself. AI can handle 80% of her emails. Did Lauren get more than 1,000 emails because of AI? No. Now she has more time, but 2 people are now out of a job because of that, right? So, it's going to be a while before those jobs come. And that's the concern that the Federal Reserve is looking at here, which isn't great. Less dynamic labor market, which is showing signs of fragility. The employment to population ratio has dropped significantly this year. Businesses are reducing hiring, but they continue to retain their existing workers for now. But what happens when they start realizing it's easy to hire people because, unemployment claims are high, and then you don't need to hire, you don't need to hoard workers anymore like you've been used to for the last, 5-ish years. Well, then you might get rid of them. And then you get rid of them. See, look at this. If demand conditions do not improve, firms may have little option other than to begin laying off workers. recognizing it may not be that difficult to rehire them given the shift in labor market conditions. Hey, if there are a bunch of workers available, why not just fire a bunch of them now? We could always rehire them in the future. I mean, that's really insensitive, but that's just the reality of capitalism. So far firms have resisted reducing their workforces, but demand is so slow right now, it's just a matter of time for the layoffs to happen. I mean, Bowman literally says the reason the Fed's waiting is because of tariffs. So, Trump's tariffs are accelerating the pain in the labor market. And that's because firms appear more willing to reduce profit margins as they're less able to pass full prices through given weaknesses in demand. This isn't good. And this is why she says we should cut rates to neutral and stop and avoid more erosion to the labor market. Now, this contrasts with what Mr. Bostic says. Bostic says inflation is a greater risk and that, we should be very cautious that we're not cutting too quickly because, again, we don't want to repeat a 1970s situation because we might not be as restrictive as people think. Obviously, these numbers make it pretty clear, but he argues that it could take 3, 6, or even 12 months for businesses to come up with pricing strategies. And because of the sloppy rollout of tariffs, his words, directly blaming Trump, we don't know what's going to happen with pricing, so why don't we wait? So you have most of the Fed that's let's just wait, and 2 people at the Fed that are like, bro, you're killing the labor market by doing this. Hopefully, courts save the day. A rough day in court for tariffs. Literally, you have an 11-judge panel skeptical about Donald Trump's arguments or his administration's arguments at the U.S. Court of Appeals yesterday. And the reason the judges are skeptical is because you have basically a president that is implying that they could use a 1977 International Emergency Economic Powers Act because Nixon did previously. However, Nixon had his tariffs ratified by Congress, and so it wasn't just a Nixon announcement, and they were seen as a temporary measure. So Nixon had temporary tariffs and Congress approved them. Donald Trump is not looking for temporary tariffs, and he's not looking for Congress to approve them. And even if he were looking for Congress to approve them, the odds are Congress would not approve them. And the judges are actually saying, hey, we're not buying it. We can't just give you the license to impose tariffs or taxes because of the major questions doctrine, which basically says for these things, you have to go to Congress. Congress has the power to demand these things, and the president isn't a king. The Constitution doesn't let him command the tides of trades, trade policies, which is very interesting. You look at some of the top 2 comments on the journal over here. I thought they were decent. Oh, if they actually load here, show and comment. There we go. If tariffs are to protect U.S. economic interests in emergency, why are we tariffing Brazil for prosecuting Bolsonaro or Canada for recognizing Palestine? Somebody else says, a global economic tariff reorder may well have been needed. However, the U.S. Constitution does not need an economic or any kind of reset. Of course, you have to be careful because a lot of people are getting fussy, taking a lot of real big sides here. I'm not a side taker. I try to just provide the facts as I see them. I quote tweeted Nick T, who said, Powell referred 6 times at his news conference to downside risks in the labor market, suggesting that realized weakness could build a case for easing policy. And I'm like, Nick T, what are you smoking? Nick T's like, Powell warned us. I'm like, no. Powell literally said we should be thankful we're not raising rates, that we need many months of data before talking about cutting rates, and the market clearly saw Powell as hawkish, not dovish. Turns out Nick T then turned off comments to that particular quote tweet. And then he reposted it again. But he turned off comments to the one where I quote tweeted him, which is interesting. It's like, wait, why, Nick T, are you being such a mouthpiece for J. Powell? Trying to play this, oh, Powell's always right. I'm a shill for no one. My goal is for everyone to hate me. And I think I do a very good job at that. Because I don't shill for Trump. I don't shill for Biden or Kamala or Newsom. I hate that Newsom guy. I'm certainly not going to shill for Powell. Now, I'll defend him when I think it's right, but I'm not gonna get on my knees and say he gave us the fair heads up. He didn't give us a fair shake. If anything, I don't think Powell knew. I mean, maybe the unemployment rate did go up, which that is the warning he gave us, but why then is he being a hawkish dumbass in that case? You know, if Powell knew, then it's almost like Federal Reserve malpractice to have been as hawkish as he was. So no, Nick T, Powell didn't warn us. That's a joke. If that's considered a Powell warning, then you know, Powell should go back to warning school. It's a joke. So we get back to, you know, best case scenario, frankly. And I said this the first time we saw this before it went to appeals. Best case scenario, all these tariffs get destroyed in courts. They all go away. And they go away before the labor market gets destroyed. Next best case scenario, the Fed starts supporting the labor market, hopefully. But honestly, rate cuts probably aren't going to do it. Rate cuts are done in a falling economy. Rate cuts don't bail out the stock market. Everybody hoping that the market's going to moon because of rate cuts, I think, is mistaken. Rate cuts are the precursor to a recession. Now, I understand, you know, the market has rebounded to the 557 line, which is exactly the line we talked about this morning in the course member live stream. A very critical line this morning we talked about in our alpha report. We also, by the way, talked about Rocket Mortgage being a huge beneficiary here. It's up 14 to 16%. In the alpha report, we talked about this before the market opened. This is why I think you should use coupon code release the files and join. But understand, best case scenario number one, because Trump's going to be too stubborn, is courts throw out these stupid tariffs and we minimize that damage to the labor market. Hopefully then we don't get layoffs and we stop the layoff cycle that has just started. Next best case scenario is maybe these job numbers were an anomaly. Maybe the QCEW revisions that we're going to get won't be that bad. I mean, it's wishful thinking, but I'm willing to be optimistic. I mean, look up the BLS labor report. Go to the bottom. They literally give you the date for the QCEW revisions. Last year it was in August. Right here. Preliminary benchmark revisions to the establishment survey data to be released on September 9th. Last year we killed like 1 million jobs when we got this in August. And it tanked the market so badly that you got the Japanese carry trade crisis. And a 50 basis point cut from the Fed. So I guess mark your calendar for 10 a.m. Eastern on September 9th. This is tough, folks. It's a tough time. With markets at all-time high, margins at all-time high, the labor market now finally starting to actually show crap, which we've seen coming for a very long time. Yeah, we had a lot of Trump enthusiasm around the election and afterwards. Gold now rising within, you know, 50 to $100 of its all-time high because people are panicking. And we're back to shock level here on the 210. Oh yeah, 51 basis points. Right back to shock level because of this data. You know, we escaped that for a moment there. Skyrockets right back up. We've been at shock level since Liberation Day, right? Like, usually being above 51 means we are prone to a shock. Now, I want you to understand, we don't know what the shock is going to be. Look at Goldman Sachs. There is no clear catalyst for an imminent collapse. Although watch non-farm payrolls, which were bad. This is true. But that's the nature of a black swan. We don't know what shoe's going to drop. We just know stuff's setting up and it ain't good. So again, I'm going to write this down just to make it like really crystal clear, okay? Best case number one, courts kill tariffs and no layoffs, okay? Best case number one. Best case number two is the tariffs stay, but no layoffs. And tariffs stay. Best case number three is productivity boom offsets layoffs. Wishful thinking. Anyway, go to meetkevin.com. Use coupon code release the files before midnight tonight If you have any questions, you can always email us at staff@meetkevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.